Many wealthy people, even with significant amount of money, still seek to reduce their tax payments. If you think they're breaking the law, that is not quite right. They use legally authorized ways that allow them to either significantly reduce their tax payments or even avoid them altogether. But how do they manage to do this? In this video, we will discuss in detail what methods rich people use to legally reduce their taxes. We will explain how these schemes work and why they are considered legal. Subscribe to our channel so you don't miss important information, and let's get to the bottom of this together. Before we begin, I want to emphasize that this video is not a guide to action and doesn't encourage you to break the law. We're just sharing stories from the lives of wealthy people and not advising you to avoid paying taxes. Our goal is to show you exactly how legal tax strategies work and why they're only available to the rich people. For the wealthy, taxes are not a one-time concern, but an ongoing endeavor throughout the year. The amount of taxes a rich person must pay is a complex combination of loans, deductions, benefits, and unfamiliar loopholes. The ideal is to pay no taxes at all. Does that seem impossible to you? Consider the leaked tax returns of the richest Americans, analyzed by the non-profit news outlet ProPublica in 2021. For several years, billionaires like Elon Musk, Jeff Bezos, and others didn't pay a penny in federal income taxes. So how do they manage it? Here are a few basic principles they live by. Refuse to take a paycheck. If your primary income consists of what your employer pays you, taxes will be held automatically on every paycheck you earn. In this case, paying taxes will be fairly simple and will come down to filling out one basic document. You can, of course, choose certain deductions that will benefit you, such as for student loan interest or home office expenses. However, most people prefer this standard deduction. For example, when Jeff Bezos was the head of Amazon, his base salary was about $80,000 a year. Elon Musk doesn't receive a salary from Tesla at all. Apple CEO Tim Cook earns the $1 million, but that's only a fraction of the $63 million he received in the past year. Most wealthy entrepreneurs receive their profits in the form of large blocks of stock. Stocks are not taxable until they are sold. Even at the time of sale, only the difference between the purchase price and the sale price, what is known as capital gains tax, is assessed. Normally, billionaires prefer not to sell their valuable shares. But then, how do they pay for their day-to-day expenses? The answer is simple: they take out loans. While all financial advisors say that loans are bad, billionaires regularly take them out. They use stocks as security. This credit cycle allows them to buy everything they need without paying a capital gains tax. Be prepared for losses. If you do need to sell assets, you don't have to worry about potential losses. Just use them to reduce your taxes. This is called tax loss harvesting. To make it clearer, let's break down an example. Imagine you own shares of Tesla stock and its value has dropped dramatically. You sell the stock at a loss and then buy a similar amount of Mercedes stock. The loss and the sale of Tesla will help reduce taxes on some or all of the gain from the Mercedes stock. You sell the stock at a loss and they buy a similar amount of Mercedes stock. The loss on the sale of Tesla will help reduce taxes on some or all of the gain from the Mercedes stock. They try to build up losses throughout the year to reduce income taxes. If you have income at the end of the year, such as from the sale of a house or other property, you can use the accumulated losses to pay less money in taxes. It is important to realize that these losses may not be used immediately, but can be saved for the future if you plan to sell assets next year. However, selling assets at a loss and repurchasing them, known as a wash sale, is illegal, keep in mind. One way to reduce taxes is to consider different tax rates for different types of assets and holding periods. For example, if you sell stocks or bonds that you've held for more than a year, the tax on the gain can range from 0 to 25%. But if you make a profit on assets you've held for less than a year, the tax can be as high as 37%. In this case, it is logical to sell the assets after 1 year. But this is just an example because taxes vary in different countries. The point is to always seek the lowest tax rate for your income. One of billionaire investor Jeff Bezos' tricks to bet on bulls the rise and fall of big company stocks. This allows him to build up short-term losses on the one hand and the long-term gains that are taxed at a lower rate on the other. Another way to save on taxes is to shift income that is taxed at high rates to places with low or zero taxes. To make it clearer, let's give an example as usual. If a business account is heavily taxed, you can move your money into tax-advantaged retirement accounts. One such option is a special life insurance with investment options, but it is used by very rich people because it can cost millions of dollars to set up such coverage. The money deposited can be invested in profitable assets. If you decide to terminate the insurance, the money received will not be taxed. When you are very wealthy, the important thing is to treat everything as a business expense. Private jets are expensive luxuries, but their cost can be fully tax-forgiven if the plane is used primarily for business purposes. The definition of primarily for business is very blurred. You may be traveling on your plane for a business meeting, but you may also be spending a few days vacationing at a beautiful resort. Private jet owners often form companies and rent out their planes when they are not using them personally to take advantage of tax deductions. In fact, many expensive hobbies of wealthy people are casually turned into business expenses. Yachts, racehorses, golf clubs, and more. While this practice is common, it has its risks. If affluent people are going to buy expensive yachts and claim that they're being used for business, they must have a real basis for such claims. The next method is philanthropy. Philanthropy has long been a popular way for the wealthy to reduce their taxes, and it comes with a nice bonus of improving their reputation. Many charities created by billionaires are tax-exempt, and donations can be tax-deductible, and you can have complete control over when and how much to donate depending on how much taxable income you have in a given year. It's a flexible way to offset taxes. The donations themselves can range from buying mosquito nets to fight disease to paying for a child's private school. For example, former President Donald Trump once used money from his foundation to buy a portrait for himself. Often wealthy people put money into foundations and organizations for charitable purposes without distributing the funds to anyone. One popular method today is an endowment fund. Wealthy people put their money into such funds, and the advisors who manage the account distribute the funds over time. But of course, such a method raises questions. Does the charitable organization really provide a public benefit? These funds are tax-free because they are supposed to fulfill a social function. Some billionaires argue that their foundations fulfill the criteria. For example, because they open a historic mansion or private art collection to the public. In reality, there are many examples of non-profit organizations failing to meet their obligations. Some of the above strategies operate on the borderline of legality, balancing in a gray area where the clear lines of the law are often blurred. In some situations, such actions may be considered permissible, while in other cases they cross the line and become risky. Many wealthy individuals may choose to take such risks, but they should be mindful of the potential reputational consequences. By choosing an aggressive tax strategy, they should be prepared for extensive document preparation and consultation with lawyers. Even after such actions, they may find themselves facing penalties or additional taxes. Complex tax avoidance schemes often employed by wealthy individuals include techniques involving the use of shell companies and offshore accounts. Such manipulations often go unnoticed during superficial audits by tax authorities, as they require a detailed study and deep understanding of financial schemes. Sometimes it is extremely difficult to draw a clear line between legitimate tax optimization and tax avoidance. It is not uncommon for wealthy individuals to challenge the results of tax audits using good lawyers to convince the tax authorities that they are wrong. Such proceedings can drag on for years, becoming an exhausting process for both parties and requiring significant resources and time. This is the end of our video. On our channel, you will find more interesting and useful videos about cryptocurrencies, financial matters, and different ways of earning money. Subscribe so that you don't miss the latest releases and stay up to date with the most relevant topics. We're glad you watched this video, and we hope it was useful for you. The Token team has been with you as always. Thanks for being with us, and see you in the next videos.